Cross-asset signals are flashing mixed today, with AI and semiconductor stocks selling off just as long yields and oil volatility keep testing the edges of the risk budget. Welcome to vTalkInsight, Allocator's Lens Daily for July 29th, 2026, where we connect equities, rates, credit, and commodities into one coherent view. In equities, the calm on headline indices hides a meaningful derating in the AI complex, especially semiconductors. Global chip stocks have been hit hard, with Asian names seeing double-digit daily moves, circuit breakers, and some leaders losing close to half their value in a month as investors reassess capital expenditure plans and competitive threats from China. Valuations in the semiconductor space have fallen back toward historical averages, but technicals suggest they are not yet deeply oversold, leaving room for further downside if earnings expectations reset. Structural headwinds are building as capacity additions by established players and new Chinese entrants threaten gross margins and even revenues over the coming years, challenging the idea that recent profit levels can be sustained. The hyperscalers at the center of the AI story are also under scrutiny. Their capital expenditure is growing faster than operating cash flow and is projected to stay that way into the late 2020s, forcing more than 80% of upcoming AI data center investment to rely on external financing and raising concerns about circular financing structures that may be propping up demand. Debt markets are already reacting to this strain. Credit default swap spreads for some flagship AI names have widened, while new bonds tied to data center projects, such as recent issues linked to large social media platforms, are coming at higher yields than similar deals last year, signaling investors want more compensation for funding the AI build-out. Yet, despite this pressure at the top of the market, the broader equity tape looks more resilient. Recent price action shows the market cap-weighted S&P 500 barely moving while the equal weight index rises, and European indices remain relatively stable even as global tech and semiconductor benchmarks trade off, pointing to a quiet broadening of leadership beneath the surface. We see evidence of rotation toward quality earnings and dividend payers. Consumer and industrial names such as Coca-Cola, Unilever, Ford, UPS, and Visa have delivered solid revenue and profit beats, often combining pricing power with volume growth, while European energy and banks continue to support regional indices and dividend-focused equities in Europe and the UK attract defensive interest. Underpinning this is a still resilient but more uneven consumer. Aggregate spending has held up thanks to a strong labor market, and card networks report high single-digit volume growth, but confidence has dropped. Lower-income households are trading down, relying more on credit cards, and by now, pay later, and rising energy bills are crowding out other categories. Volatility is increasingly internal rather than index-wide, with large weekly performance gaps between sectors reminiscent of earlier turning points like the early 2000s. Options markets show relatively little hedging around big tech earnings, and the VIX sitting in the high teens suggests that while allocators expect choppiness, they're not yet pricing a major left tail, even as AI and semiconductor names re-rate. Turning to rates, the macro data lean toward patience from the Federal Reserve, even as markets debate the odds of further tightening. Recent inflation prints, including a marginally negative core consumer price index reading, flat housing and rent dynamics, and well-anchored longer-term expectations, all point to diminished urgency for additional rate hikes. Money supply measures that separate transactional cash from store of value instruments also suggest current policy is roughly neutral rather than aggressively loose or tight. Still, the policy picture is far from settled. Estimates of a September hike run as high as around 2/3. The Federal Open Market Committee looks divided, and the chair has offered little forward guidance, keeping the reaction function deliberately opaque. At the long end of the curve, yields are being driven less by weekly data and more by structural forces. Persistent fiscal deficits near 5% of output, heavy treasury issuance, waning foreign demand as major holders cut hundreds of billions from their portfolios, and competition from large-scale corporate issuance, especially from tech and data center projects, are all pushing term premia higher. Against expensive equities, the combination of high real yields and elevated term premium makes long-duration bonds look relatively attractive on some valuation metrics, and we see flows reflecting that view. However, with oil volatility and fiscal dynamics now central to the rate debate, bond volatility remains elevated, limiting the diversification benefit that sovereigns historically provided just as equity dispersion and policy uncertainty increase. Credit markets sit directly between these equity and rate forces. Surging demand for AI and data center funding has driven a wave of long-dated issuance, and recent jumps in yields and credit spreads, particularly for hyperscaler and semiconductor debt, show investors demanding a higher premium to finance what is increasingly viewed as an uncertain Capex cycle. Deals like Meta's large data center partnership, where an asset manager funds most of the capital while the tech company keeps operational control, illustrate how balance sheet risk is being shared. Even so, new bonds are clearing at wider spreads than similar paper a year ago, and rising default swap costs for flagship chip names may complicate fundraising for the broader tech supply chain. Outside big tech, headline credit quality still looks solid. Direct lending portfolios report default rates around 1%, well below the broader business development company universe, and opportunistic credit funds have posted strong unrealized returns, with private data center loans even pricing tighter than comparable public unsecured bonds thanks to structural protections. However, there are clear fault lines. In private markets, companies often supply their own earnings and valuation multiples to agents, increasing mispricing risk, while insurers with heavy exposure to a liquid Level 3 assets could be forced to sell more liquid holdings if regulators push for higher capital, a concern made more acute by credit spreads in those sectors sitting near historical tights even as rates volatility rises. Commodities, and oil in particular, remain the main transmission channel from geopolitics into inflation and cross-asset volatility. Crude prices have swung from around $70 to above $100 in just weeks and then dropped sharply, with benchmarks now well below recent highs despite strategic reserves at their lowest levels since the early 1980s and an unprecedented 40+% drop in Middle Eastern exports. The physical backdrop is still fragile, with shipping through the Strait of Hormuz and parts of the Red Sea heavily disrupted by blockades and attacks, and continuing strikes on regional energy infrastructure. Yet prices are being held down by softer demand from China, which has cut imports by several million barrels a day, and robust U.S. production near 14 million barrels a day, leaving what looks like a disconnect between visible supply risk and market pricing. Energy tensions are not limited to oil. In the U.S., electricity demand from AI data centers is straining grid capacity, forcing power price spikes, and even warnings that facilities without secure generation could be disconnected during heat waves, tying the AI build-out directly into local inflation pressures and operational risks for both technology and energy-intensive industries. Stepping back across assets, the picture is one of growing tension between a still resilient equity backdrop and more cautious signals from rates, credit, and energy. AI-related equities and credit are being re-rated. Long-end yields are increasingly driven by deficits and heavy issuance, and oil and power markets remain volatile even as spot prices ease, suggesting that the cost of capital and the cost of energy will be central to the next phase of this cycle. For allocators, the key watch points now are big tech earnings and Capex plans, the Federal Reserve's communication around its pause, the behavior of long-dated yields and credit spreads around AI issuers, and any renewed divergence between oil prices and geopolitics. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.